As we finish up one of the most unsettling first halves of recent note, many of you have asked us the same questions. What actions are we taking to protect your capital and identify opportunities? How are we safeguarding your assets in an inflationary environment? And will there be a recession? I'm Mark Kinney, Chief Investment Officer with Newport Private Wealth, with your Q2 investment update and answers to your questions. We are very aware that this is a very unusual time, with both stocks and bonds producing double-digit losses. Our decades of experience navigating through similar times of stress have taught us that staying the course is wise and patience is critical. But that doesn't mean we've been complacent. As we highlight our activities this quarter, there are three key takeaways to remember. Number one, what we don't invest in is equally important as what we choose to own. We choose not to invest in asset classes that are very expensive, speculative, or unstable. Number two, our strategic and broad diversification has continued to keep volatility low, reflected in our strong relative performance since the start of the pandemic. We think in 3 to 5 year time frames, not month to month. And number three, challenging markets provide investment opportunities, and investment decisions made today will materially drive future performance. Let's look at some specifics to illustrate these takeaways. In the bond market, maintaining a low exposure in public bonds has long been our strategy, and we see no reason to veer from this approach. If interest rate increases continue and spreads widen, there may be an opportunity to begin to pivot. Until then, we can afford to remain on the sidelines with public bonds. Cash offers strong capital preservation in the meantime. You've also asked about crypto. We believe we must fully understand the risks we take when making any type of investment. We can't do this with crypto, so we have not invested in it. This has proven to be wise, as crypto has been a big money loser for investors this year. So how do we think about your portfolio positioning? While markets have changed dramatically, our portfolio approach has not. Our ideal portfolio is one that is less sensitive to inflation and interest rates. It also produces more cash flow to investors than a conventional 60-40 stock-bond portfolio. That's particularly important during periods of asset repricing. To achieve that objective, we favored allocations to investments such as private debt. The majority of our private debt holdings are floating rate investments and benefit when rates rise. We've also taken advantage of opportunities to deploy capital to commercial mortgage-backed securities. These fixed income investment products are backed by first mortgages on commercial properties. They provide income and growth as they are bought at a discount to par. The exclusive opportunity to invest in these products comes to us through one of our specialty managers. Self-storage, apartments, other income-producing real estate, infrastructure, all provide an effective hedge against inflation. And on the whole, our private investments in these areas reduce exposure to the short-term emotional swings of the public markets. Our allocation to alternative asset classes has been a positive contributor in a difficult time for investors. Our private asset investments recorded strong results over the past 4 reporting quarters, with 4 out of 5 posting double-digit returns. Their contribution is especially evident in our yield fund. While not immune to the negative market conditions of the past 2 quarters, the fund held its own against the benchmark, losing significantly less while generating income in an uncertain environment. Turning to the public equity side, the 20% reversal in the S&P 500 marked its worst start to the year since 1970. Only the Great Depression, the 1937 crash, World War II, the 1970s bear market, the busting of the dot-com bubble, and the 2008 crash had worse 6-month performance periods for the index than the first half of 2022. Fast rising rates have had a particularly negative impact on companies whose valuations were based heavily on future earnings, such as tech stocks. The tech-heavy NASDAQ has erased all returns since November of 2020. It's no surprise, then, that public equities were the largest detractors to performance. Despite this, we're well positioned with managers who don't invest in the shiny, highly priced stocks that were a sure bet a year ago. Those stocks are rapidly losing value and they're shine for investors. Instead, our managers invest in quality companies with sound fundamentals and strong balance sheets. Many of our public equity managers outperform their benchmarks over a challenging first half to the year. As one of our long-term managers, EdgePoint, said recently, "We don't get too fussed by noisy headlines. The reality is, nobody knows if the markets will experience a pullback, how sharp it could be, or how long it might last. We aren't good at timing the market and don't believe anyone can consistently do it well. Rather, we consider the facts surrounding the underlying businesses we own and make judgments based on those facts." Year to date, we have made allocations to our Canadian dividend, U.S., and global small cap and emerging market managers. Our deep understanding of their business strategy gives us confidence in their selection process. Targeted smaller and consistent allocations have maintained public equity weightings within our mandates and taken advantage of market weakness. This has insulated the portfolio well. When just about every asset class hit all-time highs during the pandemic, investors treated the markets like an ATM. As these asset classes reached correction territory, seemingly overnight, much of the positive wealth effect created during the first wave of the recovery was erased. That has left plenty of opportunity, but it's not enough to see opportunity. A smart investor requires liquidity to buy when others are selling. At roughly 12% of our mandates, Newport's cash balance has proven invaluable. It's allowed us to remain active and gives us ample capital to take advantage of market repricing. As Warren Buffett said, "It's best to be greedy when others are fearful." With that opportunity, we made other allocations of note. We put over $200 million to work during the second quarter. Some examples of recent activity include the following. We allocated $35 million to Hazelview, a specialty real estate manager with whom we have an extensive history. The investment includes a mix of property types and real estate holdings across Canada. We also made smaller allocations to specialty managers focused on multifamily residential real estate in Texas and Florida and an industrial real estate holding in southwestern Ontario. Brookfield came to us with a global investment vehicle focused on high-quality assets in essential services such as transport, data, renewable power, and utilities. We allocated $20 million to this opportunity. It's an excellent example of how Newport's long-standing manager relationships give us access to investments not available to retail investors. Our strategy has proven itself out in the relative performance of the Newport Balance Fund to its benchmark and peer universe. Historic relative performance of the Newport Balance Fund is a strong reflection of our process in action. In sum, we have elevated cash on hand, U.S. currency exposure that hedges the weak Canadian dollar, a bias towards income, and private asset allocations. We own high-quality assets and are generating strong cash yields. Your portfolio is well positioned and has weathered recent market turbulence effectively. What about inflation and the threat of recession? The current situation is certainly impacted by the geopolitical climate, with the continued war in Ukraine, stresses in the Chinese economy, supply chain woes, elevated gas prices, and so on. These are not new factors, and they continue to wreak havoc on a fragile economy trying to steady itself. Given all this, recession has got a lot of airplay of late, but it's inflation that is the higher priority for central banks. With the Bank of Canada's latest and most aggressive rate hike, it appears that they are prepared to risk a recession to subdue inflation. Depending on who you listen to, and we listen to a lot of smart people, a recession still seems to be a coin toss. But there are some signs that we may be in the back nine of market turbulence. Opportunities continue to present themselves. The labor market continues to be strong, as do wage levels. We are managing well through the pandemic and moving forward. And while there are no surefire signs that a recession is imminent, we know from experience that markets always look ahead. We will continue to be prudent, gauge market conditions, and keep our feet on a steady path. As we have said before, this is part of the regular ebb and flow of the economic cycle. Our investment committee has decades of experience stewarding your capital through similar periods. We know that entrusting Newport with your wealth is a significant decision, and it's one that we're honored to uphold. Thank you for placing your trust and continued confidence in our team. We wish you and your family a safe, relaxing, and enjoyable summer.